Hey, aloha. Thank you, ladies and gentlemen, for taking time to watch this video. My name is Brent from iamsuccess.com. This is your daily cash flow video game. We're going to choose the dream stock market for kids, which is right here, nicely snugged up between this opportunity and this donate. It's out here on the fast track. The way that you win this game is you either land on your dream or you accumulate $50,000 of passive income by landing on these opportunity cards. The way that you get into the fast track is you have to get out of the rat race. How do you get out of the rat race? You land on these green opportunities and you accumulate more passive income than you have monthly expenses. And while we're playing this today, the first video we're going to listen to, since we're dealing with the stock market today, we are going to listen to Death of Fundamental Analysis. Is it dead? I don't know. Let's go.
Hey everyone, this is Kirk here again from OptionAlpha.com, and in this video I want to talk about a question that I get often, and that's, is fundamental analysis completely dead? And really kind of the death of fundamental analysis as it relates to trading options and trading stocks. And so we know that with such efficient and liquid markets here in the US, that question can be posed, and I think it's a valid question to ask. And I'm not trying to, rain on anyone's parade that loves fundamental analysis, but it's a valid question to be asked when we go through it. So here are my thoughts, having worked on both sides of the Chinese wall, both as an M&A analyst and investment banker, and also as a research analyst on the side. So for those of you who don't know what the Chinese wall, it's kind of this divider in companies that they have. It's not a physical wall, though sometimes it can be a division between floors or workspaces, but it's this idea that there's two sides of the business. There's the private side of the business, which are part of an M&A, where we are structuring merger and divestiture deals with companies, and then also the public side of the business that doesn't have access to their private information when companies are going to join together or sell off one of their assets. And that's that research side. So that's where I was asking questions and working on a team that would talk to CEOs and CFOs about kind of future projections, and we would publish research on where we expected a stock to go in the future and why and what were the underlying conditions. So it was a lot of fundamental analysis, and it really had nothing to do with technical or options probabilities or statistics. It was all fundamental at that point. So I think I've got a pretty good idea of how that works, having worked both sides of the industry. So the first thing I'll tell you is that it's not dead if you're a long-term value investor. And I think, look, for me, it's a no-brainer that I don't use fundamental analysis anymore, but that doesn't mean that you can't be aware of your surroundings, right? And sometimes people talk about it and just having kind of an understanding of what's going on in the market. So if you're trading, let's say JCPenney, but they might end up filing for bankruptcy or something, or they have some important board meeting about selling the company. I mean, there's got to be some sort of understanding that you have. And I think if you're a value investor or somebody that's going to be in a particular stock for a long time, then maybe some of those fundamentals are important. How quickly is the company growing? Is their market share growing? Is their margins growing? Is their revenue growing? Some of the things that you can ask are definitely important, and obviously, so it's not dead in that sense. Number two, though, is that the community of advisors that are out there, and financial advisors, both private financial advisors, public financial advisors that are seen on CNBC, I kind of throw everyone into that advisor category. Anybody who's got an opinion on the market, they typically don't ever have their interests aligned, or they don't have a vested interest in whatever they're talking about. And I think as a community and as an industry, it's such a bad thing that when I was working in REITs, as an analyst, we could never have ownership in the companies we covered. And I get it on one side of it that you don't want to have ownership in that company because it would taint your investment, but at the same time, I gotta have a little skin in the game. You don't have any vested interest in how well this company does. It just doesn't really give you, put you in a good position to make a smart decision. And I think often people will talk about, and I'll hear this all the time on the news or in media, you should go out and buy this company. But then they don't go out and buy it, right? You should go out and buy that company, but then they don't go out and buy it. And it's such a huge disservice to this industry as a whole that advisors don't have the same vested interest in alignment. And I think it becomes more of a game of seeing who can collect and open as many new accounts and have kind of quote unquote money under management, and where it shouldn't be anything about that. Number 3 is that as options traders, we're trading shorter terms. Though we're not day trading, we're not day traders in the sense of we'll be in and out in the same day. We will be maybe in and out in a week or 2 weeks. We're position traders, but that means that on a shorter time frame, how well can fundamental analysis really help us? And it really doesn't. It's more about volatility, short-term overbought and oversold areas of support and resistance. That has much more of an impact on what we do for our timeline than fundamental analysis does. Number 4 is what I call disruptors like Amazon that are moving quicker than ever into new territory. And I'll use this example, but Netflix was one of the first movers, if you will, kind of the quickest mover into the space of offering this digital streaming content. Well, Amazon's got a huge subscriber base, and they quickly came in and took a huge chunk out of Netflix's customer base by having their own Amazon Prime and video streaming. So in this day and age, markets are so efficient and companies are so efficient that they can quickly overtake someone else's territory. Whereas most people may have thought that Netflix had kind of the end-all in digital streaming media online, they quickly found out that Netflix or that Amazon can come in, and some other players like Redbox now, they can come in and disrupt and move the momentum of that company. And so I think as a fundamental investor, if you're looking at that, that's hard to see those moves coming in. And in those cases, most of that should be priced in anyway. Alright, and so number 5 here is that markets are frankly so efficient now and so efficiently priced that when news hits from a company, it's not worth chasing. And the end result here is that markets are so fast. And if you're trading liquid underlying stocks, as recent years, things like Apple and Google and Microsoft and Intel, those companies have so many people covering them, and there's so much information out there that it's virtually impossible for you to gain an edge by having some sort of fundamental analysis information. So think about it this way. If you read as a retail investor, as somebody just like me that's, we're not in the market, we don't have insider information on any of these companies, but if we see a news story that hits maybe the front page of Yahoo, maybe hits a Google blog or something like that, or maybe some company that we're looking at, just got an FDA approval. Well, by the time that it gets all the way through the channels to somebody writing it up and putting it online or talking about it on a media show or something like that, or even on radio, by the time it gets through all of those channels, to the point at which you hear it, read it, or see it, somebody else has already taken advantage of it. Information is so quickly priced and so efficient in our markets, it's not worth chasing. So what we have to do as traders is realize that fundamental analysis can play a role in longer-term investing, but as options traders, we completely need to avoid it. And just have a little bit of market understanding. We need to have our head, in a swivel and just know what's going on, but we don't need to be looking at PE ratios and cash flow analysis. It doesn't matter, and frankly, I haven't used it in 8 years, and I've been doing it just fine without using it. So I think when we talk about this question of is fundamental analysis dead, I think that it's not completely dead, but I think it's dying as it relates to options traders and stock traders who are going to be a little bit shorter term in the market. So, as always, if you guys have any questions or comments, please add them below this video lesson, and until next time, happy trading. Hey everyone, this is Kirk here again at OptionAlpha.com, and in this video I want to help define a little bit more this concept of high probability trading and how we can really find trades that are high probability. So unlike stocks, and I'm sure you've heard us say it before, but it is worth saying over and over again, unlike stocks which theoretically have a 50-50 chance of going either direction at any one point in the future, with options trading, you can basically pinpoint the probability of success that you would like to have on a particular trade. Now, we favor option selling as a general strategy, so what we like to do is sell options that are far out of the money and give ourselves an opportunity to make a small credit should the stock not go that far out of the money and basically stay range bound wherever we decide to choose our strike prices. So in today's video, we're actually going to look at XLE and just going to use an index ETF as a good measure because it doesn't have earnings and it's highly liquid. You can see today as I'm doing this video towards the close of the day, it's got about 28 million shares that were traded today, and the options on the underlying stock have pretty good liquidity as well. So lots of contracts to choose from, half strikes, dollar-wide strikes, a lot of activity in the market. Now, one of the things that we like to do is we like to trade at about the 1 standard deviation level, and so we'll explain more about that later on as we get through this course and these modules. But basically what that means is we like to have on any one side of our trade about an 85% chance of success. Okay, and sometimes that means that we come a little bit closer to the market and we trade with a 70% chance of success. Sometimes we go a little bit further away, maybe trade with a 90 or 95% chance of success, but we like to target most of our trades around an 85% win rate. That means if we make 100 trades, we should win 85 of those times if we make 100 trades. Now here's how we kind of bring definition around it. With XLE, the stock is currently trading at about 73.5, and it's, again, live market right now, so it's moving around, but it's 73.39 right now. What we want to do is we want to go out to February in this instance, and you can see the February options have about 38 days to go. So this is our timeline of our trade, just about 38 days. And we want to make a trade that gives us a very high probability of success. And just quickly, before we look at that trade, it's important to note here that this trade, in and of itself, may or may not be a winner, but it's making this same type of trade over and over and over again, the same type of high probability trade that leads to a long-term consistency in your account and a lot of winners. So with the February options about 38 days to go, we are going to go down to about the 64 strike price level. And you can see we already have a working order in here for this spread. So a 64 strike basically means that we're going to go down below the market. Remember, XLE is trading at 73.5. And we're going to trade and make our strike price down here at 64, so almost $9 below where the market is currently trading. Now in this case, what we're going to do is we're going to sell a credit put spread. And I just want to go through that action of just selling that put spread real quick so you can see what that looks like. And in this case, we sell the 64.63 credit put spread. Again, don't get too confused on this. We've got tutorials and modules about how to do credit spreads. But again, just go with me on the logic here as we go through this part of the course. Now with this spread, and I just want to open up this order dialog box here, you can see that we can at most make $16, which is the difference between buying the 64 and selling, buying the 63 and selling the 64. So the difference between those prices is $16. Because it's a $1 wide spread, we can actually lose about $84. So in this case, we have a loss that could be much higher than what we actually sold the spread for. But that's not the point here. The point here is that we have a very high probability of success on this trade. And as I've said many times, if you are willing to half your win at $16 or some small amount and increase your risk, you have a much higher chance of success long-term trading the markets than you do doing anything else. So in this case, we're risking $84 to make $16. And what's really cool about this trade is that we have a super high probability of success. So when we look inside of our platform here on Thinkorswim, we have this column that says probability of being ITM, or in the money. And so what this probability means is that this is the likelihood that XLE goes from where it's at right now at 73.5 and trades all the way down to and below 64 between now and February expiration, which is...
We'll be right back. Ha, ha, ha. Oh, what's going on here?